Welcome back, investors. Today, we're diving into the world of industrial defense, where the stakes are high and the competition is fierce. We'll analyze some of the biggest names in the sector: General Dynamics, GE Aerospace, Lockheed Martin, and RTX Corporation. These companies are not only pillars of the defense industry but also strategic players in the global economy. So, is now the right time to invest in them? Let's break down their performance, potential, and whether they're worth a spot in your portfolio. Let's get started with the price-to-earnings ratios of these giants, a metric that tells us how much investors are willing to pay for each dollar of earnings. General Dynamics has a trailing PE of 23.15, which sits above its 5-year average of 18.01, suggesting a recent uptick in valuation. With a forward PE of 18.67, we see some caution about its future growth. This conservative outlook could hint at a potential buying opportunity for value investors, especially if you believe in its long-term defense contracts. GE Aerospace shows a higher PE at 41.75, with a 5-year average of 53.21. The forward PE of 33.09 signals optimism but at a tempered rate, hinting that the market is cautiously confident in its future earnings growth. Lockheed Martin, meanwhile, has a relatively lower PE ratio of 19.70, aligning closely with its 5-year average of 16.26. Its forward PE sits at 19.54, indicating that investors see continued stable growth. And lastly, RTX Corporation carries a PE of 22.85, slightly higher than its 5-year average of 19.23. Its forward PE of 20.04 reflects a balanced outlook, suggesting RTX remains a steady pick in the defense sector. Let's take this analysis further with the price-to-earnings to growth ratio, or PG ratio. Generally, a PG ratio below 1 indicates undervaluation. General Dynamics has a PG of 1.77, suggesting a fair valuation relative to its growth potential. GE Aerospace, with a PG of 1.40, could present a more appealing growth story, as the ratio suggests growth potential that aligns well with the current price. Lockheed Martin's PG of 6.03 seems high, hinting that its stock might be priced at a premium, which investors should weigh carefully. RTX Corporation has a PG of 2.07, making it a middle ground choice for those seeking growth at a reasonable price. Now, let's talk about insider ownership, an important signal of management's confidence in a company's future. General Dynamics has 0.63% insider ownership, a healthy level for a large-cap company, showing that management has a moderate stake in the company's success. GE Aerospace and RTX are lower at 0.29% and 0.09% respectively, while Lockheed Martin has the smallest insider ownership of 0.06%. Though low insider ownership might be typical in large corporations, it can sometimes hint at a lack of direct alignment between executives and shareholders. Profitability is essential in defense companies, which often deal with massive contracts and tight margins. General Dynamics boasts a return on equity of 16.95%, a return on assets of 6.57%, and a return on invested capital of 11.13%, showcasing its efficiency in generating profit from its equity and assets. GE Aerospace has an impressive return on equity of 25.82% but a more modest return on assets of 4.33%. Lockheed Martin stands out with a return on equity of 81.04%, although this high figure could be due to financial leverage. RTX, on the other hand, shows a more balanced picture with a 7.22% return on equity and a 2.88% return on assets, indicating moderate but stable profitability. The evolution of shares outstanding can provide insight into capital allocation strategy. General Dynamics and Lockheed Martin have reduced their shares outstanding at a compound annual growth rate of -2.28% and -3.17% over the past decade, signaling a commitment to returning value to shareholders. RTX has increased its share count at 4.37% compound annual growth rate over the same period, suggesting a different approach, possibly to support growth initiatives or acquisitions. When it comes to earnings per share or EPS, General Dynamics leads with $13.13 and is expected to grow at a 13% compound annual growth rate over the next 5 years, indicating strong profitability. GE Aerospace's EPS of $4.20 is projected to increase at an impressive 29.7% compound annual growth rate, suggesting significant growth potential. Lockheed Martin has the highest EPS at $28.18 with a projected growth rate of 3.22%, reflecting a more stable, albeit slower, growth trajectory. RTX rounds out the group with an EPS of $5.49 and a projected growth rate of 10.79% over the next 5 years. Over the past decade, General Dynamics and Lockheed Martin have had an impressive double-digit growth, leading the pack Lockheed Martin with its 10.59% compound annual growth rate. While the other two companies have had a negative evolution of their earnings per share, RTX due to its increase in shares outstanding. The free cash flow per share evolution paints an optimistic picture for long-term growth potential. In this case, only Lockheed Martin has had a positive evolution that demonstrated its ability to generate significant cash flow, which can be reinvested to fuel further growth or return to shareholders. In terms of dividends, General Dynamics offers a 1.88% yield with quarterly payments of $1.42 per share. Over the last decade, it has grown its dividend at a healthy 8.64% compound annual growth rate. GE Aerospace provides a lower yield of 0.64% with 28 cents quarterly payouts, though its dividend growth rate has declined at -12.41% compound annual growth rate over the last decade, signaling inconsistency. Lockheed Martin's yield is more appealing at 2.41%, with quarterly payments of $3.30 and a solid 9% compound annual growth rate in dividend growth. Finally, RTX offers a 2.05% yield with 63 cents per share paid quarterly, and a dividend growth rate of 5.43% compound annual growth rate over the past decade. So less initial yield and growth than Lockheed Martin's. Next, let's look at margins. General Dynamics has an operating margin of 10.12% and a profit margin of 7.9%. GE Aerospace has slightly higher margins with a 10.73% operating margin and 11.45% profit margin, reflecting efficient operations. Lockheed Martin leads with an operating margin of 12.17% and a profit margin of 9.36%. RTX trails the group with an operating margin of 8.38% and a profit margin of 5.97%, but it still maintains steady profitability. Let's see how each company's revenue and earnings have evolved over the past 8 years. GE Aerospace shows a declining evolution in revenue and earnings, which has not been reflected in its market price. Over the last 5 years, it has overperformed compared to the defense ETF, ITA. Lockheed Martin and General Dynamics have both shown positive growth, reflected in their market prices. Both companies have outperformed the defense ETF, ITA, in the last 5 years, benefiting from their focus on niche markets. Finally, RTX also saw very positive growth, though this hasn't fully translated into its stock performance. Its total return over the last 5 years has been similar to the ITA ETF, suggesting some investor caution or pricing pressure in the defense sector. Debt levels are a critical factor in today's market, particularly for companies dealing with large contracts and capital expenditures. General Dynamics has a debt-to-EBITDA ratio of 1.96 and a debt-to-free cash flow ratio of 4.85, both within manageable limits. GE Aerospace shows a slightly higher debt/EBITDA of 2.30 and a debt/FCF of 4.36, which is a bit on the higher side but still manageable. Lockheed Martin's ratios are the lowest, with a 1.68 debt/EBITDA and a 2.68 debt/FCF, indicating strong financial stability. RTX has the highest debt ratios, with 3.70 debt/EBITDA and 5.69 debt/FCF, suggesting it may face challenges if cash flows decrease. Finally, let's talk about stock performance and market cap over the last year. General Dynamics delivered a 27.17% return with a market cap of $83.43 billion. GE Aerospace achieved the highest return, posting an impressive 59.69%, reflecting investor enthusiasm, and has a $179.89 billion market cap. Lockheed Martin had a solid 24.52% return with a market cap of $131.59 billion, and RTX also saw a high return at 59.64% with a market cap of $166.95 billion. For the crystal ball moment, analyst expectations and fair values. Analysts have set General Dynamics' price target at $330.21, representing an 8.65% upside from its current price. My fair value calculation for GED is $281.93, suggesting a potential overvaluation. GE Aerospace's price target is $208.69 for a 19.01% upside from its current $175.36, but my fair value estimate is $150.59, which also indicates overvaluation. Lockheed Martin's price target is $604.34, offering an 8.86% upside from its current $555.17. My fair value estimate is $414.32, which suggests overvaluation. Finally, RTX has a price target of $134.43 and 7.18% upside from its current $125.43. My fair value estimate here is $120.47, indicating a slight overvaluation. So, there you have it. General Dynamics, GE Aerospace, Lockheed Martin, and RTX Corporation each bring something unique to the defense sector. Whether you're looking for dividend income, growth, or stability, these companies have you covered. Remember to align these insights with your own investment goals and risk tolerance. If you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell. Until next time, happy investing!